Okay, capital assets. So capital assets are personal use assets, whatever I'm using just personally, my personal car, my personal home, my personal furniture, all that stuff, my appliances, all that stuff I'm using personally, or investments that I have made, my stocks and bonds, if I own land for investment, anything that I'm purchasing with the intent, it's not going to make me money in a business, it's just something that I'm hoping is going to increase in value, and that's how it's going to benefit me. So how we treat capital gains or losses depends on these factors. How long the capital asset is held. So how long did we hold? So did we hold it? So holding period. And again, we're going to divide this. So long term, or actually we're going to say short term is 1 year or less. Long term, more than 1 year. That's our cutoff. Did we hold it? So it's gonna how much, what our tax rates are on this sale for any gains is going to depend on whether it was a short-term sale or a long-term sale. Whether the sale produced a gain or a loss. If our gains are recognized in full losses, we can offset up to $3,000 against other income. That means that if we have a loss of, let me spell that correctly, if we have a loss of $5,000, a net loss of $5,000, I can only use $3,000 to offset other income on my tax return. We're going to go through what's called netting of gains and losses. There's a whole netting process between the capital gains and losses to arrive at our net capital gain or net capital loss. And that's what we use to then offset, if it's a loss, that's what we can use to offset other income. So other ordinary income. So that's kind of a special treatment. I mean, we're going to, if it's a long term, we've got some special lower tax rates that we pay tax on. But if we have a loss, we get to offset ordinary income up to $3,000. So, and that, that ordinary income could be at higher tax rates. The type of asset that was sold, and I don't mean, I should say type of capital asset. So we've got some special treatment of collectibles. They've got a special tax rate. Collectibles are things like stamp collections or that Hummel figurine collection that your grandma had. I don't think you guys probably aren't old enough to have had a grandma that had a Hummel figurine collection, but collectibles, things that people collect in categories of items. Also depends the taxpayer's tax bracket. Ordinary tax bracket. I'm not going to say ordinary because actually the capital, we'll just call it taxpayer's tax bracket. We've got those special capital gains tax rates. So depending upon, and they're different cutoffs, just like the qualified dividends had different cutoffs. It's the same cutoffs for this. combination of all capital gains and losses to derive a net capital gain or a net capital loss. So netting. So you see there's lots of things that we have to kind of go through here. And the last one, whether capital asset sold is the stock of a qualified small business. We don't really go through that, but qualified small business stock. But these are things that you have to consider. All of these things determine how we're going to report the capital gain or loss and what the tax implication is going to be for us. Okay, so the first thing, the holding period. Whoops, here we go. Long-term capital gains get preferential tax treatment. So long-term is lower tax rates. Short-term is just our ordinary tax rates. So long-term capital asset, any capital asset held for more than 1 year. Short-term, any capital asset held for 1 year or less. And remember, before we talked about when that holding period starts. So it's the day after we bought the asset. So if I buy my 1 share of Tesla today, my holding period is going to start October 15th. If I sell it October 15th of 2026, that is short term because I held it for 1 year or less. If I sell it October 16th of 2026, now it's long term, right? If I had a gain, I probably want to wait that 1 extra day because my tax rates are going to be lower if I wait that 1 extra day, right? Holding period starts the day after it was acquired and includes the day that the property is sold. So here we've got Jackie purchased 100 shares of IBM on January 6, 2023. The stock is a long-term asset as of January 7th, 2024. So you see, if she sells it January 6, 2024, it's still short-term because it's 1 year. It's not more than 1 year. The gain or loss is short-term. No preferential tax treatment is applicable on any gain. So you can see as well how tax planning could come into play, right? If you're being strategic about your sales of assets, if you have something at a gain, you may want to wait until you've held that asset for more than 1 year so that you can get those lower tax rates. Usually they're acquired through purchase, but if it's received by gift or non-taxable change or inheritance, there are some special rules like the rules that we already talked about in the last section there. Inheritance, again, inheritance property is always long-term, regardless of how long that asset belonged to the decedent. So instead of inheriting land from grandpa, well, I suppose it still could be land if you're going to use it as investment. But you inherited grandpa's Microsoft stock that he's had since 1996. And it has a really low basis because that's when it started. So it has like a $10 a share basis, and now it's worth $550 a share. You've got a huge gain there, but because you inherited it, you get the basis of that stock on grandpa's date of death. So grandpa and you have avoided that gain, having to pay tax on that huge gain. And it's considered to be long-term as well. So even if you sold it the very next day, it's still going to be considered long-term. These are the different tax rates. So some of these, we're going to talk about some of these in the next section. Where I had mentioned collectibles are different. They have a higher tax rate. So if you sell a collectible, you pay a 28% tax rate on the sale of that collectible. We'll talk about the 2202. Well, that's the small business stock. Qualified small business stock also has that same 28% tax rate. This unrecaptured 1250 gain, we're going to talk about that more in the next section. It is a capital gain, but it's for certain business property that is, I don't know how it's considered to be capital. Remember some of those there was whether it's treated as a capital gain or an ordinary gain depended for that 1231 property. So this is one of those areas where it's treated as a capital gain. It has its own special tax rate there. These should be fairly familiar to you. These are the same as those qualified dividends tax rates. Okay, that we did. We worked on those in Chapter 3. Those qualified dividend tax rates. So same cutoffs. So capital gains. These are long-term capital gains tax rates. So it has to have been held for a year or more. For single, if your other taxable income is over $518,900, you're in the 20% tax bracket. These are the cutoffs for other. Here's another marriage penalty you can see there. If it's between these amounts, you're in the 15% tax bracket for long-term capital gains. If you're under these thresholds, then you're in the 0%. So you could have, if you're married filing jointly and you have assets and you have to recognize a capital gain, a long-term capital gain, and your taxable income is under $94,000, you pay no tax on it. So that's a huge benefit. So here we've got Matthias gave a gift of 500 shares of GM stock to Sienna. So Sienna is a sibling. Gifted it. She's a sibling on November 12th. Well, gifted it on November 12th, 2023. The stock was worth $50 a share. He purchased it for $30 a share in 1992. That's not a whole lot of appreciation, is it, for that many years? Because the basis to Sienna would be the same as in the hands of Matthias, the holding period for Sienna includes Matthias's holding period. So Sienna, her holding period is more than 1 year. The stock is considered a long-term capital gain. And she's going to have Matthias's stock basis as well. So the $30 a share. When she sells it, any gain will be taxed using capital gain tax rates, and she'll have to use the $30 a share as her basis for that stock. The capital gain tax rates, we just went through that table there, so I'm not going to be, I'm not going to go through this. This basically shows this, but the table is easier to understand than the paragraph. Let's see. That 25% bracket is a special rate, relates to capital gains generated from depreciable real property used in a trade or business. So remember, I'm going to reiterate this. So we said all of the ordinary assets are going to be taxed, are considered ordinary. Capital assets are all considered capital, but those 1231 assets, the long-term depreciable trade or business assets, could be treated as ordinary, could be treated as capital. In this case, that's what they're talking about. The depreciable real property used in a trade or business, again, this is depreciable real property. So buildings, they've got a special 25% tax bracket. So that would be the category of those 1231 assets that are treated as capital. So generally speaking, when depreciable real property is sold for a gain, the taxpayer has to bring back or recapture as income the part of the gain that's due to the difference between maker's depreciation. I don't think going into the whole detail here of this, because if they are, I'm going to wait until Thursday to talk about it. Essentially, I'll give you kind of a little preview. What happens, and I'll go through this again on Thursday, but just to kind of give you a little taste. So if you purchased let's say you purchased a building in, I don't know, 2015. And you purchased it for $300,000. And you've taken accumulated depreciation over the years of $100,000. So now your adjusted basis is $200,000. Well, when you were taking this depreciation, you got the benefit of offsetting ordinary income, right? It reduced, that depreciation showed up on your Schedule C, and it reduced ordinary income. Right? If you sold this, you had a sale of this property for $400,000. You now have a gain. Well, we'll just move this down here. This is our adjusted basis of $200,000. Of that $200,000 gain, you received the benefit. So this is a capital gain technically, but you received a reduction of your ordinary income from $100,000 of that. That gain can be divided into two parts, right? One part, the $100,000, was due to depreciation, DUE. And $100,000 was due to appreciation, or the increase in value, right? Because you bought it for $300,000 and you're selling it for $400,000, so it went up in value by $100,000. That's the capital gain part of it. But $100,000 of that was due to depreciation that you had taken over the years. So what you have to do is you've got to divide those two up, and they have different tax rates. Okay, so you have to pull out the amount of the gain that is due to depreciation and separate it from the amount of the gain, if any, that's due to appreciation. And you have to treat it differently. Okay, so it's taxed at, so instead of the entire, this is called the Section 1250 property. So instead of the entire gain from the 1250 real property being taxed at preferential capital gain tax rates, instead of all $200,000 being at a capital gain tax rate, this is going to be at the amount due to depreciation is going to be at a 25% tax rate. And the amount due to appreciation is going to be at our capital gains tax rates. And it's going to be long-term. It wouldn't be 1231 property if it wasn't long-term. So the highest tax rate that we would have is 20% for the amount that's due to the increase in value, right? And we're going to talk a little bit more about that. This is just kind of a preview of it. So to avoid the possibility a taxpayer might get around the special tax provision by not claiming depreciation, there's also, you have to, so even though it says the amount due to depreciation, what some might do is think, oh, well, I'm just not going to take depreciation on it over the years. Well, even if you don't take depreciation, the amount that you have to recapture is the same. So what they say is it's depreciation allowed or allowable that you have to then claim that on. So again, the gain is divided between the amount of the gain that was due to depreciation and the amount of gain that is due to appreciation, different tax rates for both of those. The amount that's due to depreciation has that 25% tax rate, whereas the amount that's due to appreciation then gets the capital gains tax rate. And we're going to go through, again, we're going to do more on that in the next section, as well as here. Let's see. That's probably good. You guys are already packing up, so. Have you maxed out? All right. Sorry, I don't really give you any breaks, but